Carried interest, what it is and how it applies to private equity funds. Carried interest is sharing the profits that general partners receive for managing an equity fund, such as a VC fund. The profits are long-term gains, dividends, short-term gains, or interest. They can total 20 to 25% of the fund's profits. This carried interest is for the general partner that is payable at the sale of the fund. You start a venture capital fund in the form of a limited partnership. You appoint yourself as the general partner, which means you have to manage the fund and are responsible if the fund fails. You find interested investors who become limited partners who have no liability if the fund fails. You, as the general partner, receive a percentage payment based on the money you put in, just like the limited partners. You would also receive payment for managing the fund or ordinary income. If you receive a larger percentage of the profits over what you invested, this is the carried interest, which comes with capital gains tax. A typical fund contains several companies that pay off in 4 or 5 years. Carried interest is paid over and above the management fee, which is typically 2% of the value of the fund assets. For their compensation, general partners have many decisions to make and duties to fulfill, such as finding all the investors, organizing and managing the fund, bearing 100% of the risk, invest up to 10% of the capital, maintain relationships with the portfolio companies, develop strategy and maximize the value of the fund before the sale of a portfolio company. Carried interest is important because it provides incentive for general partners to take on the risk. It is taxed as capital gains, and it isn't paid until the limited partners are paid back for their initial investment. Carried interest is figured differently from fund to fund. Normal funds combine losses and gains to determine the base for profit sharing. General partners only take profits on the winning assets. This is usually more profitable for general partners. Deal by deal carried interest can be harmful for VC funds because many general partners only pay attention and count profitable portfolio companies and ignore the other ones. Carried interest is figured by the equity in the fund. Interest is based on the limited partner's capital contributions. 20% becomes allocated to carried interest.